Okay, welcome everybody to the Cooperative Maine Business Alliance P5 Learning Series. I am Emmy Anderson, the Network Coordinator for the Cooperative Maine Business Alliance. I'm really excited to have you here today. This is our first in a series of 5 workshops that we are putting on this spring for our Maine cooperatives and other small organizations. Yeah, so let's move into our workshop agreements. We want to ask you today to change your settings to speaker view by clicking the icon in your top right corner. We would also like you to introduce yourself by putting your name and affiliation in the chat. We would like you to keep yourself muted and to be listening carefully and pay attention to our presenters throughout the workshop. We would also like you to save your questions for the Q&A session at the end of this workshop, both verbal questions and questions that you might want to put in the chat. We want to do that so that we don't lose sight of those questions. And it will be easier for me to monitor that if they all come towards the end of our chat. Also, if you have any tech-related questions, you can chat me privately as to not disrupt the presentation. You can also email me at emmy@maine.coop if you have any questions. And then towards the end, we would like you to fill out a feedback survey that I will put the link in the chat for towards the end of our presentation. So today's workshop will focus on on getting our organizations loan ready. So in the spirit of Principle 5, which centers around education, training, and information, we will learn about that. And we have a really great set of panelists. We have 4 panelists that have extensive lending and financing experience. And then we will have a fairly long Q&A towards the end of our workshop. And with that, I'm going to stop sharing my screen. And we have with us today Deborah Hawkins, who is going to moderate today's panel. She is a steering committee member with CMBA, and she is also the loan officer in Maine for the Cooperative Fund of New England, who lends to co-ops. And I just want to say before I hand it over to you, Deborah, that I'm very excited to have you here. I think you put together a great panel, and I'm really excited to hear the discussion moving forward. And with that, I'm going to hand it over to you.
Thank you, Emmy. I'm really glad to be here and glad to be with these great colleagues. Excuse me. I am going to simply tell you all their names and where they are, whom they're representing, and then turn it over. So I'm going to do them in the order that they will be making their presentations. We have Daniel Wallace, who's the Senior Vice President of Lending and Investment at Coastal Enterprises, otherwise known as CEI. And then Carolyn Edsel-Vetter, who's the Cooperative Business Support Officer for Cooperative Fund of New England. Then Patty Duffy, the Chief Lending Officer at Maine Harvest Credit Union. And Dave Libby, President and CEO of Town and Country Credit Union. Thank you all so much for being here. And we're going to start off with Daniel.
Great, thank you, Deborah. Thank you very much. It's great to be here with everyone. I'm going to do a quick introduction to my organization, but then get right to workshop content. My task here today is really to provide some high-level lending insight, sort of the frameworks that lenders often bring to evaluating your business, so that you can carry that knowledge forward and understand better how to interact with a lender. But really quickly for CEI, Coastal Enterprises, our mission is to grow good jobs, environmentally sustainable businesses, and shared prosperity here in Maine. And we do that by integrating financing, business and industry expertise, and policy solutions. So we are not a bank. We're actually set up as a loan fund, which puts us in the alternate lender camp. We've actually been lending to co-ops ad hoc for over 40 years now. And while lending to co-ops is not a primary business line, the way it might be for Co-op Fund of New England, we do have a lot of co-ops in our portfolio. Our lending average loan size is about 200,000, but we do micro lending, so that's 5, 10, 15,000, all the way up to $1 million or more. So enough on the advertisement there. Want to switch into talking about the 5 C's of credit. So this is one of those frameworks I mentioned, and it's whether when you're working with a lender, they ever actually reference the 5 C's or not, it really is the structure that's in the back of the mind, and it's the way a lot of the analytics are put together. So while it is high level, it's worth understanding. And as I go through these, I'm going to highlight a few flags, a few ways that lending to co-ops is a little bit different. So you can also be sort of putting that into your brain bank to think about how to work around those challenges in the future. So the 5 C's, I'm doing these loosely in priority order for CEI. Doesn't mean they're priority for anybody else. And really the first 2 C's I'm going to use are neck and neck for top priority. So the first C is capacity. This is the ability to pay. So when a lender is evaluating your ability to pay, they're going to focus primarily on cash flow. And they're going to get that understanding of cash flow from your historical numbers or your projections. And it's going to enable the lender to understand that you can, in fact, do your business, make a living, have an impact, and pay back your loan. So it's all about ability to pay. The second C is character. And I would describe this as the propensity to pay. So you have the ability to pay, but are you actually going to send in that check every month? So the traditional lender way of looking at character, for better or worse, is to look at credit reports. And I'm not going to go deep into the pros and cons of credit reports because for most of the lending we do and cooperative lending that I understand, we actually don't pull credit reports. So then the question becomes, how do we establish character without relying on a credit report? And there are a number of different ways that lenders can do that. A huge amount of it has to do with relationship building and communication. But it also, in co-op world, has a lot to do with governance, which Carolyn will be speaking to shortly. The third C is conditions. This one is kind of a big one, actually, but it really speaks to the industry you're in, the market conditions. What does the market look like for your business? How adaptable and flexible is your business to challenges that might come up? So this is a lot about market and industry analysis. The fourth C is collateral. Collateral is something that Patty will spend some time discussing, so I'll be brief. But for a lender, collateral is the secondary source of repayment. So if the loan goes sideways and the lender has to be made whole, they look to the collateral. So this is business assets, real estate, something that the cooperative business owns and has pledged to the loan. Debt, and I'll get to this a little in more depth. When you're looking for a loan, collateral is pretty important because it is that secondary source of repayment. Debt looks for collateral. So collateral shortfalls can be a big deal. Sort of a second flag, because sometimes cooperatives have a harder time plugging collateral shortfalls. Traditional businesses can, not that I recommend it, but traditional businesses with 1 or 2 business owners can pledge personal property on loans as one way of filling that gap. And that's really, frankly, it's not a great idea anyway, but it's, you know, even more challenging in the situation of a cooperative. The final C is capital. So capital is often referred to as skin in the game. How much individual resource, how much owner resource, owner capital, owner equity has been put into the business? How much money has the owner brought to the company? So that is also a little bit tricky for cooperatives. Certainly your membership equity counts, but providing sufficient equity to meet a lender standard, which could be 10% of a project or 20% of a project, can often be a challenge. So that's sort of a third flag for cooperative lending and for your thinking about challenges that you might get seeking loans. I want to touch really briefly on a second lender framework, which is the way that most lenders think about getting their money back. For better or worse, we want our money back. And we think about that in 3 tiers, typically. The first is cash flow. I've touched on that. That's the capacity C. Is there enough money coming into the business to satisfy all the needs of the business, have the owners earn an income, and then pay the debt? Most of us are cash flow lenders. There are so-called asset-based lenders, but I'm not going to talk about that. We could in Q&A if folks were interested. The second way out is collateral. I've already talked about that some. The third way out is guarantees. And guarantees take different forms. And often with a standard business loan, you ask the business owner to put up a personal guarantee. So that individual business owner has to guarantee the debt personally. This is a sort of a final flag in my story here for cooperatives. CEI at least does not expect personal guarantees of all the co-op owners when we're making a loan, but we still have to get comfortable with the loan even without those guarantees in place. So it's an additional hurdle. There are also other types of guarantees that other entities can provide, like here in Maine, the Finance Authority of Maine, for instance. I've just got one more block here, and I'll turn it over to Carolyn. And this is thinking about how debt fits into your planning and the risk that's associated with debt. So I like to think about this as a capital continuum, a spectrum of flavors of capital. And I actually have a graphic that I'll pass on to Emmy, who can distribute if she wants. The Vermont Flex Capital Fund has a very nice graphic. But on one end of it, you're going to see debt. And on the other end of it, you're going to see traditional equity. And there are many different types of financing along that spectrum. You know, one thing to think about with debt is that it's pretty conservative. It is an obligation to pay back, typically on a monthly basis. Of course, it could be quarterly or annual, but it is a steady obligation every single month that has to be met. And it's backed up by collateral or guarantees or whatever structure has been put in place. So that really elevates cash flow as the primary consideration for a loan, and character, as I've described. The lender's first obligation is to do no harm to you as borrower. And so sometimes this creates conflicts because we're coming to our analytics are suggesting that the business is going to really have trouble cash flowing and it's going to be a real burden for the company, whereas the company really feels contrarily that they'll be able to make it. And there's also, of course, a psychological element to this obligation, this debt obligation. How comfortable are you with it? How stressful is it to meet that monthly obligation? If things go poorly, how do your group dynamics as a cooperative hold up to address the challenge of meeting the debt obligation? So I just want to summarize by saying, I hope that some of these comments gave you some insight into how lenders look at deals, but also, flagging these items like credit scores, personal guarantees, potentially owner injection, potentially collateral shortfalls that may make it more difficult for a cooperative to secure financing. And I'm hoping with this kind of knowledge base, you would be able to go and interact with your lender in a more dynamic way to overcome the hurdles. So thank you very much. I'm going to turn it over to Carolyn for our next segment.
Thanks, Dan, and thank you for the really good setup. So just briefly, a little bit about CFNE, Cooperative Fund of New England. We also are a community development loan fund like CEI, and we've been providing affordable capital to cooperatives and community-owned enterprises since 1975. We're working toward a vision of economic justice for all through thriving cooperative enterprises. And we provide flexible financing to all types of co-ops, worker, housing, consumer, and producer. We have two loan officers on the call, Maggie and Deborah, as well as Johan, who is our other technical assistance provider. So welcome to all of you guys. And one thing that is unique about working with CFNE is, or any other mission-based community lender like those on this call, is we don't just provide money. We really partner with cooperative businesses to make sure they can succeed by providing education and coaching and connection to cooperative peers. As a regional lender, we also get involved in actually building out this ecosystem so it's more supportive for cooperative businesses to make sure that you have, the policy supports and the educational connections to really succeed. And so, in my role as a cooperative business support officer, I'm both doing the direct coaching with businesses, but also working on building those partnerships with other TA providers like CDI and others to make sure that co-ops are supported. By way of introduction, so I've only been at CFNE for 2 years, and before that I spent 20 years with a yard and a half landscaping outside of Boston. So I actually got introduced to CFNE as a borrower first, and I'm going to be leaning a lot on that experience for this presentation. So in 2013, the owner of a yard and a half gave us the opportunity to form a worker co-op and buy the business from her. And so we formed a worker co-op, and CFNE provided us a substantial portion of the loan toward actually doing that purchase. So the two things I want to focus on today are governance, as Dan alluded to, and also the importance of a business plan. So when a yard and a half started talking to CFNE, Maggie, who was our loan officer, asked to see financial paperwork, which we expected, but she also asked to see our incorporating documents, so our bylaws, our member agreements. And I was a little surprised that she would care. But as Dan alluded to, that's really important, particularly in cooperative lending, because governance is the best way to sort of evaluate your co-op's capacity to pay the loan and to be a functional business. During this pandemic, we've gotten a chance to work with both co-ops and some conventional businesses and really seen the strength of the co-op model in having strong governance and being able to be really aligned around a mission and make decisions quickly together as the thing that has kept cooperative businesses afloat at higher rates. And a lot of that's really spelled out in your governance, in your bylaws and your operating agreements. Those documents should sort of define, here's how we operate democratically. Here's how we make decisions together. So quick question for people, either show of hands or throw it in the chat. do you know how your co-op makes decisions, and what is that? It might be collective management, it might be an elected board, it might be sociocracy, it might be consensus. Just take a minute to throw in a word or two about how your co-op makes decisions if you're part of a co-op or a potential cooperative project. Modified consensus. And what I'm hoping to see is if there's a range of folks here, there's no right way to do it other than the way that's right for your co-op and the way that's clearly understood among all the members. Consensus. Yeah, depends. Elected board. Cool. So regardless of how you agree to make decisions together, having a healthy democratic decision-making process that everybody understands is really critical to deciding to take on debt, because your future members are going to be responsible for repaying the debt that you take on. So being able to show your lender that you have a plan for how you're going to onboard new members, develop them, keep them educated and informed, is what is going to show your lender that you're going to have that long-term ability to repay, and that member turnover is not going to negatively impact your either your financial or your human resources. The other piece of this is your business plan, and developing a business plan actually is a great way to get your members involved in really understanding how the sausage is made, how the business works, how you make money, how you're going to repay that debt that you're taking on. So the process of putting together a business plan or discussing one if you already have it with your members can be a really good way to engage them in building consensus around the decision to take on debt. Okay, another one in the chat. Yes or no, how many of you have a current business plan in place for your co-op? And I say current because some of you are already up in an operation, but ideally this is something you do take out of the cupboard once in a while and just check it out and see if it's current. Yes, working on it now. Yes, revising now. Good job, you guys. You rock. So again, when a yard and a half started working with CFNE, Maggie said, well, I need to see your business plan and some financial projections. And I was kind of like, because as a conversion, we didn't initially, when we started planning, we didn't really have those together. And luckily she was able to give me some resources, some templates from SCORE, which is a organization of retired business professionals. And so if you, SCORE is the acronym, good place to go and get free templates and resources and stuff. And she sort of said, now, this might hurt a little, like it's going to be a lot of work. And it's true, but it definitely made our business stronger. It made our application stronger, but it also made our team stronger, because at the end of the day, our office manager knew that we didn't want to take an appointment with a job that was 45 minutes away, because we had a strategy around density in a few high net worth neighborhoods. And the guys on our crews knew they had to do their best work every day because we charged a premium for offering a lifetime guarantee on our work. So everybody was super aligned around, here's what our business plan says. The other thing that's good about having a business plan is that it sort of lays out the plans that back up your financial projections. So you come to your lender with your financial projections and your budgets and your cash flow, and your business plan really shows you how you're going to implement that. So if you've projected that you're going to make X amount of revenue in a given year, your business plan is what shows, here's what our market is. Here's why we think we can come up with that number, that net income number. Here are the operational steps that we're going to go through to make sure that we make that. Here's our pricing. Here's why we think it's low enough that it will sell, but high enough that we're covering our costs for what we're making or selling. If we lose a key vendor or a key customer, here's how we'll pivot and be able to make sure that our business can still keep going. All of that's kind of spelled out in your business plan. And so back to the 5 C's, your business plan really shows, thank you, Emmy, really shows that you can deliver on that plan to repay your loan. just quickly about financial projections. So obviously, you're going to have an annual budget. You're all probably familiar with that. For a loan, you're also usually going to develop a sources and uses budget where you say, here are the types of capital we're bringing to the table, and here are the sort of one-time uses that we're applying for money for. So like say you're starting up a cafe, you might have uses of the build out, paying staff as they're being onboarded and trained, pre-launch advertising. And your sources might be the loan you're applying for, but also, you know, member buy-ins, maybe an economic development grant, et cetera. And then the other piece of your projections will be the cash flow projection that Dan alluded to really show that you can, you know, not just have the numbers work out at the end of the year from your budget, but actually month to month have enough money to make your loan payments. So just real quickly, if I can give you sort of one takeaway from this presentation, it's that you don't need to wait until you're ready to submit a loan application to talk to any of us on this call. We're really happy to, you know, think through with you what your options are, how much of a loan you can afford, ways to get that amount down, and ways to maybe strengthen your business plan. So I'm really looking forward to hearing more from all of you guys in the Q&A, and I'm going to pass it over to Patty.
Thank you, Carolyn. I am from Maine Harvest Federal Credit Union. Sorry, Deborah, I had to get the federal in there. We'll get in big trouble if we just call ourselves a credit union. We are Maine's newest credit union in 30 years. We were chartered in October of 2019. Credit unions are the nonprofit cooperative financial institutions operated for the benefit of their members. It's the reason we chose the credit union model. We are the only credit union in the country dedicated to supporting farmers and food producers. And at least when we took on our extension, we were the only credit union with the .coop in our email extension. So we're kind of proud of that. It took a lot to get that. You have to apply, you just can't use it. Maine Harvest Federal Credit Union's deposits up to $250,000 are federally insured by the National Credit Union Administration. We have deposit accounts, savings, and long-term CDs, 5 and 10 years. We use those deposit accounts as the funds to provide our loans. Our maximum loan size, because we are so new, is maximum of $225,000 to any one borrower. Our maximum equipment loan size at this point is $45,000. But we have just requested from NCUA, the National Credit Union Administration, permission to increase the amount of our loan, equipment loan, up to $75,000. So that's a little bit about us. I'm going to drill down a little bit into equity, collateral, capital needs, and how to put together the capital providers. This is about 3 weeks worth of coursework. They've asked me to cover in 10 minutes. They have given me an extra 2. So I'm going to start with equity. Dan touched on it a little bit. Lending is about managing risk for everybody, the borrower and the lender. I talk with my hands and I'm Irish, so don't ask me where I got that from. But for the lender, it's about getting paid back. For the there's many other risks, but it's mostly about getting paid back. For the borrower, it's, is this financing going to provide enough money to repay the debt, the interest on it, and contribute to my profitability? Real important. Equity is what you bring to the table. Historically, commercial and agricultural lending, you need 20 to 30% equity or capital to come into the projects. Dan mentioned 10%. Some of the lenders on this call that are economic development or state or federal maybe can do a lower percentage of equity. The other thing that equity does from a lender's perspective is keeps you as the borrower engaged. It keeps you at the table. It keeps your skin in the game. And what I tell people is it is so exciting to watch that equity grow. You know, your annual financials that you put together aren't just for your lenders. They really are for you to see what you've accomplished. And when you see that equity grow, and it's going to go up and down, it's awesome. And that's what you should be striving for. Your equity also provides borrowing capacity. Trust me, as soon as the ink has dried on that promissory note, you're going to need more financing. Either revenues didn't meet projection, the bulk tank blew up as soon as you bought the farm, the cooler you bought from Wisconsin showed up, and guess what? It doesn't function, and you forgot about the $2,500 shipping fee. So borrowing capacity is important. A lender should never lend you your last dollar. If they do, you probably should find a new one. It also helps cushion against uncertainty. In the last 11 years, we've had two unprecedented events. We had the Great Recession of 2005 to 2009, which continued to affect real estate well into 2012. And we're still in the middle of the COVID-19 pandemic. This will change how lending and financing is done in the future. The last great impactful type of event might have occurred in the Great Depression, the hurricanes and the floods of the 27s, the pandemic of 1918. So this will impact us moving forward. Economic conditions can affect the value of your assets. A lender will at least annually review each borrower's loan as well as the collateral for the loan and how the business is doing. Most of us that are regulated lenders have to do this every quarter. So it's not that, we just want to pick on you, but, in the middle of the dairy crisis, when everything price-wise was dropping on equipment, we couldn't very well ignore that fact. In the middle of the Great Recession, when property values were changing in a negative way, which we many of us, probably most of us had never seen. Not many of us are still lending that were born in the 30s. So it can really impact your equity and thus your lender's risk rating or concerns or opinion of the loan. Equity does not make loan payments. Cash flow makes loan payments. So you can have all the equity, you can own a whole bunch of stuff free and clear, but if you can't pay back the loan, asset-based lending is not what you'll typically see the organizations represented on this call. Personal guarantees are an important part of commercial or business lending. Again, a cooperative model, they're a little bit more challenging, but be expected if you're a non-co-op that you're going to be signing personally for your business debt as well as a business owner. So now we're going to move to collateral. Collateral is the security for the loan. It's your incentive to repay. And typically our loan policy and procedure dictates what type of collateral we can use for what type of loan. So if you as a borrower are bringing 20 to 30% equity to the table, then the lender is lending 70 or 80% against the value of that collateral. That's called the loan to value. You'll hear us talk about that all the time. Collateral comes in a whole bunch of different forms. It can be land, equipment, livestock, furniture, fixtures. It can be receivables, cash, letters of credit, someone else's guarantee, someone else's assets. It can be something that's totally intangible or really hard to put your fingers on, or go and collect in the event the loan is not paid. We try to match the useful life of the collateral to the term of the loan. So please don't come in and ask us to finance, that cooler for 15 years, but we're more than happy to do that extension of the building on long term. Again, you match the collateral with the type of loan, because if you pay for that cooler over 15 years, you're not going to have any borrowing capacity. Lenders have different methodology for evaluating collateral. Some commercial lenders will take 50% of the financial statement or the listed value on the balance sheet. Some lenders, like Maine Harvest Federal Credit Union, which deals in agricultural equipment, which tends to hold its value. Yes, it can depreciate if it's not well maintained. We could lend typically a higher amount towards that equipment. Commercial lenders might lend 50%. Maine Harvest Federal Credit Union can lend up to 80% as long as it's not specialized. So let's say you want to purchase, and I do apologize because some of my topics is more agriculture, but let's say you're forming a cooperative processing plant and you need to purchase a dehider or something that takes the hide off of a beef carcass. That's a very specialized piece of equipment, not likely to lend up to 80%. Because there's not a lot of strong market. Only this particular processing type of business could use it. Many lenders want the first lien or first position on collateral. Dan talked about the continuum. You go from a senior lender who's got the first lien or the first mortgage. Lien is typically used for equipment, furniture, fixtures, livestock. Mortgages for real estate. You've got it all the way down to unsecured debt. The farther you get away from normal debt, I think that's a term Dan used, the more expensive it gets. So you've given us the business plan. You've given us, what you have for equity. You've told us what you need. And we're going to ask more questions. We're going to want to know, as Carolyn was saying, what are all of your capital needs? Those change over time. They depend on where the stage of the business, what stage the business is in. We can look at what your needs are and then help determine what's the best structure to put together. And that could involve pulling in the state and federal economic arms, the Cooperative Fund of New England, the people that could perhaps meld together some of the additional capital, but don't necessarily need the best priority lien on it. There is a lot of other ways to get capital, and they can include investors, getting preferred equity. They can include mezzanine debt. They can include friends, family, and fools. The more complicated it gets, the higher the risk, typically the higher the rate you're going to be paying. One of the things we've talked about is, maybe somebody can step forward and in a cooperative situation, provide either private financing or a guarantee. Private financing or individual financing is kind of scary to traditional lenders. They're kind of an unknown. Before the Great Recession, almost anybody could, hold a mortgage or provide financing. After the Great Recession, some additional regulations have gone in concerning mortgage, private financing. But keep in mind, a lender that needs collateral or a secured lender is not going to go behind those private individuals. Those private individuals, a seller that's going to hold the note is going to have to be towards the tail end of who could collect if the asset has to be sold because the loan's not being paid. And we work together all the time. So I want to just make a few comments before I turn it over to the next speaker. Which lender should you work with? How do you know who to reach out to? I'd just like to say we're all normal. We're not scary. Hopefully, we're very approachable. We love your questions, and our goal is to help you achieve your business and your personal goals. Communication is important and critical. Can you envision being in a 2 or 3 hour meeting with the person that you want to do financing with? You have to share not only success stories, but failures. Are you comfortable admitting mistakes and asking for help? What kind of knowledge does this lender, what value does the lender bring to your team? Agricultural lending is pretty specialized. We have some different classes of assets. We oftentimes have collateral that dies. I know there's not a lot of people amongst the commercial lenders that really want collateral that dies. We work together all the time. We'll help you get to who you might need to put together the best financing for your business. We've all been talking about commercial business lending. Maine Harvest made the choice to concentrate just on agricultural finance. There are many great credit unions already in this state that can do consumer lending and provide other banking services that we don't. And it's real important that they're separate because there's a lot of difference between them in compliance and disclosure. So with that, I'm going to turn it over to Dave Libby of Town and Country Credit Union, and he's going to tell us a little bit about what their credit union offers and how they're willing to step in and help all of our businesses, all of our cooperatives, because in the end, we're all people, individual people. Thank you. David, take.
Thank you, Patty. That was great. Appreciate it. So I'm coming at this a little bit different. I think as Patty kind of alluded, I want to talk about Town and Country a little bit, and then more in general about what credit unions are, and give you kind of a little bit of background on some of the different types of credit unions. And one of them that Patty's credit union, Maine Harvest, is about. And then really in the overall context of discussion is going to talk about one of the 7 cooperative principles, which is cooperation among cooperatives. And so, Patty, thank you very much. That was a good lead-in. And so I think it's a really important piece because it resonated. I think I made a note here, relationship. If you heard from everybody here, it was all about getting to know the person you're dealing with and spending a little quality time really getting to know each other, because there's these putting together the loans, obviously it can be complex and there's a lot of needs, and everybody's unique in the business and model that they're running in case of a cooperative, or in the case of just farmers that Patty's helping, or many others. So just a quick on Town and Country. We are a Town and Country Federal Credit Union. Again, I'm David Libby. I'm the president and CEO. Been at the credit union, just celebrated my 31st year just the other day. And so you can see a little bit of color here with the beard growth, but I call it the COVID beard growth. But anyway, so I've loved being in the industry. It's cooperatives are truly special, as you all know. And I hope that they can continue to grow, because there's a lot of benefit, a lot of need out there. And we can see what co-ops have done across the world, have done some phenomenal things and are pretty well established in other countries. In the US, of course, we know about electrical co-ops and farming co-ops, and we know about credit unions. Credit unions are the biggest co-ops in the United States. 350 million Americans, about 135 are credit union members, so greater than 30%. And that's growing fast every day. And the credit unions represent a broad range. For our credit union, we're the 4th largest credit union in the state, almost 500 million now, actually, representing 40,000 members that live in Cumberland and York County, and across the world for that matter too, that we service with our technology and such. We have about 120 employees, 6 branches, and 1 operation center based in Scarborough. And we are a member of the Maine Credit Union League, which is a trade association here in Maine, as well as Credit Union National Association. We work really closely with the World Council of Credit Unions that does a lot of work for credit unions around the world, but also has various entities that work closely with the National Cooperative Business Association and the ones or other associations like it in UK and many other countries. So a lot of collaboration among the credit unions and helping other cooperatives. National Credit Union Foundation, another foundation that supports assisting co-ops and especially credit unions and communities as such around the United States and the world. And some other things that we've gotten involved with is the National Cooperative Bank, which some of you are probably familiar with, and has gotten more involved in looking at financing cooperatives. And then we've done a lot of work with the Portland Food Co-op. We actually helped them on their membership drive to get started the first year they started. We were cross-promoting them in our branches. We assisted them with donations to start their cafe area, bought all their furniture and such. And then in addition, I actually invested in the credit union for their building as a funder initially to help them out, get them started. So we did a lot and I became a member myself. And then we're working on a current project, which is the co-op housing projects that are starting up here in Portland. And so we're working closely to see how we can help get those kicked off and see if we can help the members. The different types of credit unions out there represent a broad range. Patty's is directed very specifically to a niche of farmers, which I think is extremely exciting. There are other credit unions that are community-based like ours. We serve 2 counties of Maine. Around the country, there are sort of greater metro markets of, say, Houston, big markets. There are low-income designated credit unions and serve specific census tracts of low-income and minority populations. And then there are, let's see, one other one, community development credit unions, which are, and Patty, I think you guys might be actually considered community development somewhat, no? Okay. And those are really exciting as well and have a lot of opportunity, have different ways of funding their capital through different agencies of the government to help grow communities that are struggling. And so a lot of different types of credit unions out there. And then there's seg-based that are what we call multiple development groups that, or multiple employer groups, which will service across a broad range of employers. And for town and country, what we were trying to figure out with this particular panel is that we are not a business lender currently, although we have that in our strategic plan and it is coming. But we do a business purpose loans up to $50,000. So we are very familiar with those. They're small dollar loans, but typically the plumber who needs a truck, many other small pieces of equipment, other things. But there are many credit unions in Maine, about half the credit unions in Maine and across the country for that matter, that offer full, robust business lending programs, typically financing multifamily buildings, apartment buildings, to shopping centers, to and then heavy and farm equipment, as Patty's credit union is doing, as well as fleets of trucks and cars and delivery vans, what have you, and a whole host of other things. Not a ton in kind of like inventory type of loans, but all the other types of loans. So you could reach out to many number of credit unions here in Maine across the country and ask if they have a business lending program, and then they could run down to see what they could do for you. I do not know of many credit unions, if really hardly any, that have done a specific co-op loan, related loan. I've heard there are some recent ones where they've done some work to fund a food co-op's building or portion of it in a participation style loan with like the National Cooperative Bank and some others. But there's not a lot. I think is growing interest in trying to understand how we can do that. And our regulators, National Credit Union Administration, is very interested in trying to understand those types of loans and be supportive of those as time goes on. So, but we offer on the business side, though, a full, robust business services for checking, money markets, sweep accounts, online and mobile banking, savings accounts for the business owners. And we have something about 1,500 business accounts in the Southern Maine market. And then, of course, on the consumer side, about everything imaginable from IRAs to checking, savings, money markets, certificates, CDs, and a whole host of others. And then a long laundry list of loans that cover every gamut of the traditional loans. And then for our credit union, more than most is a lot of loans that are in that help with people of low income, minority, and other types of unique, more needful groups that are restricted and have limited access to credit. So we're very innovative in some of the loan programs that we design. And then we have a lot of big on counseling, coaching members for financial literacy, and then a lot on other tools where they can access their credit, much like a Credit Karma, but more extensive, and help understand how they can build credit. So where I think we can come in for cooperative, or just credit unions in general, co-op support is one, the business account services. Co-ops could reach out and seek credit union to establish their business account relationships with a credit union, and then of course develop relationships with that particular credit union. They have business lending services, and it makes it a lot easier to seek out the additional funding source and build the dialogue that you need to get to the next steps. And the other piece is really on the consumer side. A lot of these co-ops that we're understanding, learning more about as their own members. The idea to help pitch to their own members, member owners, employees, or what have you, to actually seek out and become a member of a particular credit, join forces with that credit union, and offer those consumer services to them, because obviously vastly better deals across the financial industry, better rates, lower fees, just hands down. So it just really would be a smart decision to encourage your own employee and other co-op owners to become a credit union member. Those would be some of my thoughts, I think. What's my time left here? Probably close to end, right? Okay. Great. So that's all I have. And Deborah, who's
Thank you so much, Dave, and thank all of you. I want to introduce a special guest. It's a kind of surprise to me, Chris Linder from Mainstream Finance. Chris, I don't know if you want to turn on your camera for a minute, but I want to thank you for being here. And I hope you're still here. There you are. There's the wave.
I'm still here. Hey.
Your position changed on the screen. I want to thank Chris and Mainstream Finance. One of the panelists has alluded to this, that one of our cooperatives, a worker cooperative, Rock City Coffee in Rockland, Maine, was a conversion. So they wanted to buy the business from the owner, and we often help with those transactions. And sometimes the purchasing owners may or may not individually have their equity buy-in right away. They might not have the whole thing. They might have to pay it over time out of their paychecks. And sometimes there's enough collateral that we can help with that, Cooperative Fund of New England, and sometimes not. And Mainstream Finance came in and was willing to offer loans to each of the worker owners for their full equity buy-in. which gives the cooperative a really firm beginning, as all of you lenders on the call know, and then accept payments over time that were deducted by the cooperative from the worker owners' paychecks. And this was really an incredibly helpful process. And this sort of thing is something that is possible in the future from not only Mainstream Finance, but other organizations, other lenders like it. So thank you, Chris, and thank you for being on the call.
Sure. Thanks for calling me out.
Yeah. So we have a half hour for questions. So I want to invite people. You can unmute yourself, and there's a small enough group. We shouldn't have people all jumping in on top of each other. If you want to unmute yourself and ask a question, you can also put it in the chat. And I want to remind our panelists, if you can just go in the chat and quickly put in your name and email address, so those who are attending can contact you later. So, open for questions. No questions for anybody about anything. Okay, well, I have some questions that I can ask our panelists. There's a very, very important one, and I think I will ask, well, we'll start with Carolyn and then Daniel. What happens if we can't make payments on a loan? What does that look like? And how might we prepare for that possibility? Carolyn?
Can I punt? Or would a loan officer like to jump in? You're muted.
I can dive in.
Let's just pass it off to Daniel. Sorry.
Patty or Dave, I appreciate any backup. So this is, not a great situation if you get to this point where you can't make your loan payments. So one thing I would say before I forget is to back up and talk about something that Patty touched on, which is the importance of communicating with your lender and developing a relationship with your lender. The worst situation per this question would be that you literally can't make this month's payment and you're telling the lender for the first time. Because one way or the other, the lender's flexibility is greatly hampered if it needs to be done under the gun with limited to no information. So really what is ideal for the co-op and your planning efforts is to make sure that you go through this whole process to get the loan. Don't then just totally forget about it or your lender in particular. Every so often, a couple times a year, check in, provide updates. I mean, it's likely you have to send in specific financial reporting anyway, particularly after tax season, and use that as an opportunity to check back in and update your lender. And then anytime you're starting to worry or things are going sideways, get in touch. Let them know what you're thinking about. Let them know what the challenges look like. Let them know how you're thinking about trying to solve them. That feels awkward, right? Because the lender was hugely important in getting you your loan. And so kind of coming back and admitting vulnerability and challenges and concerns might feel to you like the wrong move. It really isn't. We really need to be up to speed, because that then enables us to look at your situation, how bad is it? So is it a short-term problem? Is it a long-term problem? Is it a hiccup or a mountain? Just flesh out what that looks like, flesh out and understand your plan to recover. Because there are ways in which lenders can work with you. Could be simple. I mean, we did this a lot, of course, through the coronavirus pandemic. Some very basic levels of payment relief, loan modifications. It's not necessarily easy for your lender to do this. I mean, there are lots of considerations, but there are ways in which we can flex. And it's much more likely that we're going to, if we've got the information and have had the heads up over time, so we can think about how to work with you on it.
I have a follow-up question, and then there's a question in the chat. If you're in that situation and you have mustered up the courage to come talk to your lender, you must be connected with service providers or technical assistance providers. I'm sure through CEI you have the Small Business Administration, what's it called, SBDC, to support you with maybe adjusting business plans and things like that. Could you speak a little bit to that?
Yeah, thank you so much for the prompt. The organizations on the call here today are more than just straight money lenders. There's a lot of other capacity that we bring to the table. And Emmy, that's exactly right. I mean, we have in-house at CEI business advisors that we could connect the co-op to, so you could get some expertise and input and strategies. But CEI also, we've been around Maine for a long time. We know a fair number of the players. So if it's not an SBDC counselor who's the most appropriate fit for your company, we can make connections to others. I mean, I know the Cooperative Development Institute is well represented today. That's certainly a go-to for us. We can bring those other resources to the table to try to help out. And again, if we've got some notice, that gives those folks the time to interact and think and support and plan versus the last minute kind of request.
Yeah.
If I
And
could-
Amy, before we go to the question in the chat, I just want to ask Carolyn. Carolyn, do you have anything to add to what Daniel has said about resources for assistance?
Yeah, I mean, just similarly that depending on the nature of what's causing the difficulty paying, if it's a business plan issue, if it's losing key staff, if it's, internal conflict, whatever, thinking about both the business plan, but also referring to, consultants in specific fields that might be able to help, because sometimes an interpersonal or a governance issue can be the thing that's really sinking the ship. That early and frank reaching out is so important. And the worst thing in the world is to sort of get wind of something from a third party and be like, "Ooh, that co-op is suffering," and like, should I butt in and ask them what's going on? It's much better to hear from it. I know that your lender looms large, and it might feel bad, but just ask. We're all human beings. And also just to reiterate sort of the value of that ongoing monitoring, that when we ask you for like quarterly financial reports, it's not to be nudgy, it's because sometimes we can see something there that might be a trend and just check in. If you haven't approached us, that gives us an opportunity to just reach out and say, "Hey, everything going okay? Anything we can do to support?" We've been, all of us on this call have been doing this for a long time. And the social capital aspect is something that we can all bring to the table.
And Deborah, if I could interject that, pre-COVID, I would put 12 to 1,400 miles a month on my vehicle, because most of the work we do, a lot of it's done at the place of business that for our borrowers, because it's hard to get the farmers away from the farm. So that drop in kind of thing, you shouldn't be nervous about it. It is because we're going by, or maybe we did hear something, but we are there to help. And so I don't want, all my colleagues here have said great things, but I want to take a stab at Doug's question in the chat first, if that's okay. And Doug's question, I think everybody can see it, but when looking to borrow to fund a large project, what is the number one thing lenders are looking for before agreeing? I think when you think about what Dan started us with the capacity, cash flow, ability to repay the loan, I would say is typically the top, but there is 5 C's of credit. And so if that one is, again, you still have to have the capacity that meets our policies. Some of our policies allow you not to have $1 left over for every $1 of debt that you've paid. Some of us can go under that, but there could be some things that lift up whatever is the weak stool. I like to think of it as a stool, but there's only 3 legs. There's really 5 legs in a lending relationship. So, if one of those legs is a little shorter, the other has to be a little different, and which angles the other 2 prongs have to be. I think the other thing is, it's okay to say where you're weak at. Acknowledge, maybe you need 20% and you have 19.5% equity, or you have 18. So don't just think, well, they're not gonna notice. And the other thing to remember is most of us on this call have been doing this for a while. So we've probably seen your situation, whatever's going on, as far as if it's a hiccup or if it's a major torrent running down through the middle of the business. We can help provide some, we can't call it advice or we get in trouble with lenders' liability, but we've done this probably more than you have. So we might be able to bring some other ways of supporting that large expansion that might have one of the criteria that's a little weaker.
Thank you, Patty. And I'm going to surprise my colleague Maggie to speak as a loan officer to this question from Doug, if you don't mind.
Hi. I think what was said at the beginning about what a lender looks for from any borrower is what a lender would look for a large project renovation. It is your ability to repay. It's the, I don't know, sounds a little hokey, but like strength of character. It's whatever your cash flow is. Are you, do you have a desire to repay? Do we have a relationship where you understand that in many ways it's a symbiotic relationship? We tell a lot of our borrowers that the borrowers repay us, that sets us up to then be able to lend to other co-ops. It's a larger, more systemic approach, I think, in a lot of ways. And many of our borrowers, maybe not all of them, but we see ourselves as sort of in a partnership. So if you're coming in for a large renovation, I'm in Boston, so renovations are almost always large renovations. Property purchases are always large property purchases. And we do look at cash flow and we look at ability to repay. We look at the borrower not getting in over their heads so that they're not moving into what can ultimately perhaps not be the best situation. But we also look at that relationship building and the character of the borrower and the way they govern and the way they make decisions and the viability of the enterprise as a whole, I think.
Thank you, Maggie. And I want to add something, Doug. I hope you don't mind my saying, Belfast Co-op many years ago started, borrowed from us to help, I think, with a move to their current building. And one of the things I would say with a seasoned cooperative whom we know, we would also look at the longevity, the history, as a source of a general sense of reliability. Not that we would ignore the things that Maggie has mentioned or that Patty has mentioned, but this speaks really to the relationship and knowing our borrowers. And that would play some part, certainly, in this kind of thing. We'd more be, in some ways, well, is there some reason we shouldn't? Is there some new kind of problem? Is there, some issue that would get in the way?
So I don't want to totally beat this question to death, but I'll add two more things. So I would have a question right back at you, Doug, of course, because that's the way this works. But I would see renovation, which suggests to me some level of construction and real estate upgrades, as different from a straight business expansion that's being driven by, a straight increase in sales. So I would actually have to separate out those two potential purposes. One would lend itself to more of a construction loan, different style of loan, with some different parameters to it. But the real comment I want to make is around the expansion. I happen to be looking at a couple of companies right now that are expanding really rapidly. Awesome, right? That's exciting. But one thing that I look at very quickly is how much of that expansion are they funding with debt, the topic of our conversation today, versus an additional source of equity from members or from some other source. There are just too many sad stories of companies that expand really rapidly and do that on the back of debt. And you have to front load a lot of your expenses. And if the revenues don't start flowing in for a period of time, then you can't make those debt obligations. And all of a sudden you've got a major problem on your hands. So maybe I got into the weeds too far there, but I would really focus on the pace of that expansion and the mix of money that you're bringing to try to expand.
Thank you very much, Daniel. And we have a new question in the chat. Would anybody be willing to elaborate on the use of receivables as collateral? So I can do with that. Maggie can help. Daniel.
I'm happy to start us. I just don't want to talk too much. Oh, and
What?
Patty just unmuted. Do you want to go for it?
What I'll say is, as the newest credit union, we're not allowed to use them. So I'll defer to my colleagues. So
yeah, I mean, that's, CEI technically can, but we shy away from it. It's a receivable. You don't have it yet. Are you going to get it? How confident are you going to get it? What percentage of receivables could we potentially lend against? So typically, receivables are not a strong source of collateral for us. And if we are in a situation, because we will look at it, where we need to flex to help make the deal get done, we will discount the receivables at a very high rate. So I believe Patty did talk about discounting collateral originally. But with something like receivables, let's say you've got 100 grand of receivables, we're probably going to give you, if it's us, $25,000 or $30,000 worth of value on that $100,000 worth of receivables, because there are just so many questions there. Now, there are lenders out there, factors. You have to be super, super careful. But there are lenders that do receivables financing. So, that's the kind of conversation you could engage with, but that can also, there are good factors, but it can also lead you down in the wrong direction pretty fast if you're not careful.
I can add to that. Thank you, Daniel, that one of the things as a lender we'd have to look at is what is the span of these receivables? Do you have a lot of customers who just don't feel like paying or are unable to pay versus how often is this turning over? And I just want to share one of the reasons receivables tend to be problematic is if the business fails and a lender has to go after them, it's hugely expensive and it's unlikely to net a great deal of those receivables, which is why, as Daniel says, it might be 25, 30%, maybe 35. And again, it depends on the business too. There might be a borrower who has a seasonal business that's very, very stable and that those receivables are coming in because they always have and things haven't changed appreciably. But it's probably one of the least favorite types of collateral. Carolyn.
Yeah, this is, it's not exactly the same, but related, I would say, is when we're lending against like a government contract or a grant commitment where there's a much higher likelihood of repayment. And so a lot of the times, we'll do a loan that's structured more as a line of credit to cover, well, we do a lot of government contracting and it takes them 6 months to pay us, or, we have this grant, but it only pays out annually or whatever after we've, front loaded the expenses. So just to keep in mind that can be sort of a different source of funds too.
Thank you, Carolyn. That's very helpful. And I'm glad you brought it up. So I had not thought of it. Anything you want to add, Maggie? Nope.
No, I think that covers it. Thanks.
Okay. Other questions? I see Doug wrinkling his brow. No question. Okay. Well, let me see what else I have here. A lot of these we've covered. Can you talk more about different flavors or types of capital and when they might be appropriate? Or blending different types of capital and how that works? Who would like to take a crack at that?
Well, I'll start. I'll make a couple comments. Many people think I've got to have a line of credit. Just got to have a line of credit. Everything's going to be solved if I have a line of credit. It's going to just help. So lines of credit are very important. You have to have them. Their purpose is not just to have interest-only payments. Their purpose is to provide capital when your revenue stream is not consistent. And they really do need to be paid back. So again, most businesses need debt of some kind. Was on a call just recently with a fund proposing that they're going to forgive debt if farms aren't 150% profitable within the first 10 years. And I'm like, wow, that's a big ask. Because it really depends also on how your financials are, but really matching what you're using it for and allowing that capital to be paid back so that you can use it again when you need it in the future. It's so important because you'll lose the ability to borrow if you just keep stacking. What you need perhaps in the early stages of your business is going to be different. We're not likely going to be as enthusiastic if you're a well-established business, you're coming in for that expansion, and boy, your cash position has just not really been where it needs to be. So, there may be some tweaks needed because of that. And I'm going to defer to the balance of my panel and my colleagues and Deborah, that might not have been your question, but those are a couple of my comments.
No, that's very helpful, Patty. Thank you. I think one useful thing about thinking about a capital stack are some of the newer things that startup co-ops can get involved in, such as crowdfunding, such as, engaging. There is a food co-op in another state that developed a really strong relationship with the neighborhood it was in. And it was able to get a tremendous amount of startup support, of equity donation support, mainly donation support from its neighbors, not just its potential customers. So there are ways for a business to, in that startup phase, and sometimes even in an expansion phase, depending, to do some fundraising of various kinds. And I think those avenues have been opening up more. And as have been mentioned in the past, Dan mentioned the Finance Authority of Maine. Depending on your need, there are agencies that are in place that are intended to be able to support specific kinds of projects and needs. And those, it's very useful to become as familiar as you can with those. And sometimes your current lender or your prospective lender can help you find those various resources. And I know Carolyn is very familiar with them as a business support person for CFNE. Any other contributions?
Yeah, just very briefly. The financing landscape can sometimes seem just impossible. There are so many types and styles of lender. There are so many types and flavors of capital. And then as you dive down into choose debt capital, there are so many different ways debt can be designed and structured. So I think, a point here is more about general education about what's available out there, even though it can be sometimes frustrating to navigate. But really, from my perspective, Patty had said something during her presentation that I want to just underline, which is that she was just talking about rampant capital stacking. That's no good. But there are lots of ways that lenders can work together with you on your company. So it could be that one of us does a senior loan. That means it's a first position on that collateral, but another one of us does a subordinate loan, which means we're still supporting the same project, but we have a second shot after the senior lender at that collateral. And then maybe there's a seller note in there too, and that person is third in the stack. Or maybe you're working with one of the investment clubs and they're willing to come in with some unsecured debt. There are reasonable ways to meld all of our resources together, and hopefully your lender or your primary go-to on financing matters will help you do that too. Because that way, potentially one lender thinks a project, they can't do it all, and they can bring in somebody else to help out, and it spreads risk, and you bring the strengths of many different organizations to the table. One last thing is there are different structures of loans, of course, participation, side-by-side loans. There are just lots of ways that quality lenders can work together to try to help you out. And that's part of the way I think about that question.
Yes, Carolyn.
Yeah, and related to that, I mean, I think that, your financial projections, not just for year one, but looking out several years, I think can really help you think about what are the appropriate types of debt and how much, or of capital, and how much of each do you need. So, if you look at what is a vanilla term loan going to cost you over the first few years that you're open, you might look at that and say, we can't actually make those payments if that were the only source of financing that we had. So what are ways that you can, you know, build in either doing a bigger, you know, member loan drive or more member equity or community investments, or you know, as Daniel said, are there other lenders who might look differently at the balance between risk and impact and say, okay, this is riskier, but it's going to be high impact, and we can give you a more patient loan where there's no repayment up front, but down the road you're going to owe a higher percentage based on your revenues or whatever. So just knowing that there are a lot of creative options out there, and I think all of us, you know, can think creatively about making connections with lenders who do that type of stuff.
Yeah.
Deborah, you just went on mute, and I just want to take the opportunity to highlight the question in the chat from Hans. What if you're brand spanking new as a business, less than 1 year in operation? What can we do now to position us favorably in the future?
I'm going to jump in and say, back to Carolyn and everything that's been said, your projections are realistic. Don't take those projections, shove them into the drawer, because you can't really tell how you're doing unless you're comparing back. So, and you know, the old saying, cash is king, is really true. So whatever it takes to squirrel that little bit of cash away, because that first year is going to be so difficult. I hearken back to a group of 4 individuals. They were cousins. I met with them in the porch of an old rental house. They wanted to start a 10,000 tap sugar bush. I had a lot of sugar makers in my portfolio, knew their aspirations to get those first 10,000 taps in was probably pretty high, but nope, they assured me they could do it. I think they got 6,900 in that first year, but because I was able to say, what are you going to do if that you don't get 10,000? How are you going to support this plan? They had a backup plan. I know it sounds crazy, but any business should always have and be considering an exit strategy, even as a first year business. It doesn't mean that we think you're going to go out of business, but it's always easier to try to figure things out when things are moving fast and furious, if you've at least given some consideration. And then look into other businesses. The neat thing about scores, what I find in Maine, the cooperation among cooperatives, farmers, food producers, distributors of our products, our processors, is unsurpassed to any other parts of New England and New York where I've worked, where I've spent my whole career. So great state of Maine's hitting it out of the park on that. Other businesses, talk to other businesses. It doesn't matter. They don't have to be the exact same business. Maybe they're in the same stage. Maybe they're a business you knew struggled, but now is hitting it out of the park. Those sugar makers I talked about, in less than 10 years, they've gone into, they have taken the company up to 22,000 taps, purchasing from an additional 8 or 10,000 taps, producing all organic syrup and distributing it across the country. They always said they were going to use their ski mountain, which they produce it on, as marketing. I said at the beginning, oh, come on, they're not going to care about this out west. I was out west in the Sierra Nevadas and saw their syrup for sale. So, you know, they've also gone to where the ownership of the company has changed, and they've split. 2 people now own the distribution, 2 people own the operations and the production, and that wasn't easy. It takes a lot. It takes a whole lot. So anyway.
Thank you, Patty. We are at time exactly, and I know that Emmy needs a couple minutes. I just want to make a really quick pitch especially for you, Hans, Slow Money Maine. There are slow money organizations all over the country, but these folks in Maine have been an incredible way to connect with resources to help with capital stacks, actually, and to get support of all kinds. So I would get on their mailing list and keep track of their events. They're very, very helpful, dedicated folks. And with that, I want to thank everybody for being on the call. I want to thank you for your questions. Thank our panelists. Thank Emmy for putting this together. Thank Dave and Daniel and Carolyn and Patty for being on the call. And turn it over to Emmy for last ending housekeeping.
Thank you, Deborah. Thank you to everyone on the call. I have put our feedback survey, a link to the feedback survey in the chat. I just wanted to double check because we are at 2:30, are we not?
Oh, wow.
And this workshop is scheduled to end at 3 o'clock. So we can continue because I feel like this has been a great discussion, or if we are all in agreement that we can end here, we can do that as well, but it's up to you, Deborah.
Wow, I am very, very embarrassed. Okay. I'm happy for us to go on, and it is supposed to be 1 to 3, and I'm not quite sure what I was thinking. Obviously I wasn't. So if there are any other questions, or if any of our panel want to add anything, I also still have some questions I can throw out there.
I have a question that's not necessarily related to debt, but as a way for startup businesses to gain that cash, going through crowdfunding, like you mentioned, Deborah, is an alternative to maybe generate that cash. But as far as I understand, there is a cap to that. Like there is some sort of limit to how much you're allowed to crowdfund without reporting that to the SEC.
I hear Carolyn shaking her head. I see Carolyn shaking her head.
I do not have the exact facts and figures in my head, and if somebody else does, please jump in and interrupt me. But a lot of it depends on, there are different tiers of crowdfunding that are regulated by the government, by the SEC. And so, you know, there are some limits. I want to say it's like $1 million or $2 million. There are some limits to how much you can raise annually, as well as whether you're registered to just raise from within your state or multi-state. And then the filing and reporting requirements become more onerous as the amounts increase. So, you know, I know there's an option for up to 5 million where you are actually registering, you know, to sell securities, and there are, you know, more limits about how you can publicize that and to whom. There's also limits on accredited or non-accredited investors, but it's loosened up a lot since, like, there was a law passed during the Obama administration that did make it a lot more feasible to fundraise through a platform from non-accredited, just normal folks, investors. If you want to see a really cool example of somebody doing a good job at this, the Boston Ujima Project has different classes, different investor classes, and they actually have a worksheet that investors can fill out to sort of see which classes they're eligible for. They're a loan fund. They're not doing crowdfunding, but it's a similar. They're beholden to the same types of regulations.
Thank you, Carolyn. And Ben, I see your hand and I see your question.
Oh, sorry, I have a different question for right now. I got a couple of direct messages about my chat question.
Oh, okay.
But my question is, if are there ways to work with a lender if you have a somewhat seasonal business in terms of loan payments? I know we have like agricultural panelists here that could probably answer this question, but even non-agricultural seasonal business, is there a payment? Is there a way to work with a lender to set up basically a seasonal payment plan?
Well, I can, oh, I'm
Yes.
sorry.
Sorry, we do that. In fact, that was one of the first things that I made sure our system could do, because it is so critical for the seasonal business or businesses that have fluctuation in revenues. My sugar makers would typically be set up with 2 to 4 early principal payments and accrued interest only payments all the other months. Never do I ever recommend only lump sum principal and interest for 2 reasons. And I'm a very conservative lender. We go back to what we chatted about. People get out of the habit of paying, it's not good. If somebody has only 2 to 4 payments and they're not making any other payments, you really don't have a good idea if there is an issue. And, if you've only set up these large payments, I will not set up one payment a year, one annual payment, typically, just because if you run into a hard time, it's really difficult then to move that much. So absolutely, we can do that. And it recognizes the seasonality of some of the revenues, or just every business doesn't generate exactly the same revenues.
Thank you, Patty. And there's a question here from Micah. Any advice, thoughts on pursuing debt investment from private individuals, pros and cons versus from a lending institution? So Daniel, I see you've unmuted yourself.
Oh, I was going to answer the last question and I didn't remute again.
I can take over the other question, Dan, if you want to answer the last.
Well, I also
I'm
can.
curious myself about what our panelists think. So I'm going to go back on mute and see if somebody else jumps in.
Well, I think the moderator's allowed to jump in. I'm going to take that privilege. One of the capital stacks that has not been mentioned is so-called private investors who in a cooperative do not have voting rights per se, but they have lent money to the cooperative, usually in a startup situation or in an expansion situation. And it's been on an arrangement of payments, may not start for a while, or they may be dependent on financial position of the cooperative at any given time. But there is a capacity for that. And in the state of Maine, it involves some legal ramifications, legal processes that have to be gone through for a co-op to be able to accept that kind of financing. But many of our larger cooperatives have done that or needed to do that from time to time. Or a startup that was just very capital intensive. So that is a possibility, but I would recommend you just be very aware of the legal hoops and be very aware of your capacity, projected capacity going forward. And you'd also have to inform any existing lenders, which goes for any additional borrowing you do after you have borrowed money. Your existing lenders need to know about it because they have a stake in making sure that you're not biting off more than you can chew, or, as been said, aren't getting so debt heavy that it's really not healthy for the borrower or for the lenders. And then I will leave that open. Patty, what did you want to?
I was just gonna say, this is a time when legal representation for you and your business is important. You do want anything being proposed to you reviewed by a set of eyes that can give you a legal opinion on it. You know, the complexity and how they draw up the documents, what they use, you know, and this again, when you're talking about investors, it may be a little different than I think of private financing. Some of the private financing, they simply give you a long amortization table, and then, you know, they're just crossing it off. So get legal representation to review whatever is being proposed to you, because financial institutions, we have to abide by regulation and disclose certain things within our notes. So, and all of our paperwork, sometimes that's not necessarily done as well if it is simply a private individual or a small investment that is flying under the radar of some of those other.
Yeah, so I'll now jump back in since you all triggered the thoughts in my head. I agree. The thing I was going to say, because CEI sees this fairly often. And so the comments that have been made are on target. What I would say is it's a two-way street, right? There are two entities, the lender and the borrower. And ideally, you have a comfort level going in each direction. It's a legal obligation, but there's also a lot of this that ultimately is about trust. I'm gonna give you some money. Are you gonna pay me back? And so you need to know that, clearly you need to understand that private individual on the other side of the table. What are their motivations? Why are they doing this? And that's where I have seen it be successful fairly often here in Maine. But then absolutely doubling down on what Patty said. At the same time, you've got to protect yourself and understand what you're entering into. So thinking about it as a two-way street, thinking about it as Maine Harvest Federal Credit Union, CFNE, CEI, we have a pretty public position in the marketplace. People know us. You can learn about us. You can't necessarily learn about that private individual. So there is an additional level of risk there, but sometimes it can work out.
Thank you, Daniel. Other questions? Yes, Maggie.
I just want to mention that I work with a number of housing co-ops, which often start with what they call allied lenders, friends and family, who will lend money, mostly so that the group can come up with their 20% down payment on a property purchase. But increasingly, I've seen worker co-ops, rather than do sort of the friend and family route, although a lot of them sort of bootstrap that at the beginning, will go into a much more structured setup where they will offer preferred shares. So you set up a mechanism whereby individuals can invest or lend money to the co-op. It's strictly regulated. There's like a third party involvement. It's not so much like you, Deborah, are making Maggie a loan for me to start up my business. It gets a little dicey sometimes. Preferred shares or direct public offerings, which can take money from non-credited, is that the right term? Non-accredited investors. They're not inexpensive to set up, but if you're trying to raise like a big whack of money from individuals, it's, I think, really, really helpful to have that sort of legal structure behind you. Thank you,
Maggie. And I could not remember the words preferred shares when I was speaking earlier. But I appreciate your elaborating on that, because that has been a very helpful process for those who can afford the setup and who are going after something that needs that kind of extra investment.
I would add that it can create a ready pool of supporters in some ways. It's not unlike members in a food co-op who feel, hopefully, like a level of obligation and responsibility to the cooperative because they're members, because they've put equity money in. That often expands to like a member loan program, which is also pretty structured and controlled. But some worker co-ops that have sold preferred shares or direct public offerings, which are usually, I don't know, $2,000 a share, so more affordable to a broader group of people, then find that they have a pool of supporters so that, I mean, I have one borrower who's needed additional funding. They've gone back to the people who invested in their DPO, and those people have been willing to make additional loans or buy additional shares because they have a relationship with the co-op, with the business, and that they want to make sure that it stays alive. So it can be sort of in a weird way. I mean, it increases your debt, but it also creates a sort of safety net.
Right. And some are even amenable to appeals to donate rather than collect on their investment. And some are willing to extend the original agreement of when to start paying, et cetera. And I didn't mention that on the, when a cooperative gets loans from its members and community, it's usually very acceptable to these private lenders to take a pretty small interest rate, which can be a big help when raising funds. Anyone else want to comment on this, including folks from some of our co-ops? Okay. So let's see. I threw in the chat that CFNE also does seasonal repayment plans, depending on the business. I see that Daniel put something about that as well, and we know that Patty Main Harvest does that. Okay, so I'm going to see what other interesting question we might pick up before we prepare to end the call. This is an interesting question. We've already discussed business plans, but this question is, if I only need $100,000, why is a business plan needed? Why can't you just lend me the money, for goodness sakes? So who wants to take a crack at that? Oh, come on.
So that $100,000 request, you are trying to provide the most concise information so we can turn around your loan request as quickly as possible. It is a requirement. So, you know, I hate to sound like my mom, but because I said so is probably one of the reasons. But, you know, it's your opportunity to show how you shine. It is your opportunity to showcase yourself, and it's going to be important. We should be able to do almost all of our underwriting off of that. It really puts everything into a condensed, tight place and gives you something to look back on. You know, if you don't give us a business plan, we're going to ask you for everything else in that, especially if you're a new borrower, because we're getting familiar. So it's not for the lender, it's for you and your business. So you flushed it all out so that you're ready for those questions when Dan asks you, you know, what was this little hiccup? When Carolyn says, boy, you know, you've got 3/4 of this being raised by an instrument that you need SEC, you know, regulation. You've got the answers for it. You've thought it through. You've thought everything through that is going to help make you.
Thank you, Patty. And there's another aspect to this. I'm not sure I can speak for CFNE. We will often offer a longer period of amortization of a loan in order to make loan payments affordable, especially in a startup. But when the actual term of the loan, so let's say we have a 5-year term on the loan, we may offer 10 years amortization to figure out the loan payments. But after that 5 years, you're going to need to ask us to extend the term or give you another 5-year term. When that happens, we may ask you, have you updated your business plan? Are there any aspects of your business and the environment you're doing business in that have changed that you now have to take into consideration? And certainly this pandemic has been a huge call for that, for what we're now calling pivoting. So that business plan is not just important to get the loan to start with, but to keep up with the process. Or even if you just come to the end of the term and want a new loan or want to borrow more money than you originally borrowed, that business plan, it often turns into what's called a strategic plan. And I know they're not quite the same, but the business plan can be used to keep your strategy fresh going forward. And this also ties into something that the pandemic has given rise to, even more importantly than usual, is when you make projections for a lender, those projections can be looked at and modified as you go through a year when things are happening that are unpredictable and unexpected. So they've become particularly important during a pandemic. Are the projections you made for the year that you're in, are they still working? Do you need to do any recalculating based on your actual sales and expenses going forward? And there is a cooperative, well, actually it's a company, it's a CPA firm that recommended looking at those projections in this environment monthly. And it means doing it by hand on an Excel spreadsheet, right? QuickBooks is not going to do this for you, but it can be very worthwhile when you are working on this flexibility and pivoting that this pandemic has created the need for, but also that may be more of a operating environment going forward. So, any other questions or comments?
I was wondering a little bit more about business plans, because there are a million resources out there available that suggest that you write business plan in a certain way. But is it worth it to reach out to the specific organization that you think might be able to support you the best and ask what they want to see in that business plan, along with everything else that needs to be in there? But are you, CF&E, going to ask for things that might not be in these generic resources?
Carolyn.
I'm not going to speak from the underwriting perspective. I'm going to speak from the what I see working or not working from co-op's perspective. I think it's far more important that the co-op members have ownership of what's in the business plan and are really comfortable that they can implement on it, than that it fit within any particular format. I mean, do you have an executive summary? Do you have a section for this or that? And, if you need it, you can go back and add it if the lender asks for it. But what's really important is everybody knows who are your target market, who are your customers, why are they buying from you and not from somebody else? What are the things you need to do in your day-to-day job that make that value proposition true? Making sure that everybody throughout the co-op gets that is so much more important than formatting.
Yeah, make it concise, make it clear, make it understandable. And when somebody asks you a question about what's on page 5, be able to answer it. I don't care what format it comes in. I'll take a slide deck, I'll take a document, but concise, clear, on target, and you can answer any questions that come out of it, is my recommendation. I've seen 5-page business plans that blow 25-page business plans out of the water. So it's not about length, it's not about aesthetics, it's about that core knowledge embedded inside of it.
And coherent with your financial projections.
Yes. That's an interesting situation as an underwriter. There may be a fairly long process in the loan application process, and things will get updated. Some things will get updated. But if you're going to update projections or something else, you need to go back and update other things that are connected. I know that that's a pretty technical little bit, but our loan committee is definitely going to notice when things don't match up. So that's just a little technical tip.
The only thing that we ask that's a little different, and all we ask for is a paragraph. The farmers or food producers, our borrowers have to provide a sustainability plan and a climate resiliency plan, because we have tied in, that's the way that we can tie in focusing on keeping our environment, our soils, and our climate healthy. So I say no war and peace, similar to Dan, where you've been, where you're going, who you are, how you're going to get there with financial projections, and what your markets or what you're trying to, market into, or members you're trying to get. So those are a couple of comments on Maine Harvest business plans, only required for real estate loans over $50,000.
Thank you, Patty. In a way, it's like show the lender that you can get where you want to go and know what you need to know to do that. I mean, that's the basics of a business plan. And there's actually, you can go online and find 100 examples, and essentially they're not that different from each other. And it isn't bad to see those as a little checklist, but again, I think what's been said already about really it being your vision and your commitments is what the lender wants to see. Okay, I think it really is now.
Yeah, it's time. Well, go ahead.
Just thank everybody for being here. And thanks again, Emmy. And I turn it over to you.
All right, that's all I have to say too at this point. Thank you so much for being here. Thanks for being great panelists with really informative answers to a lot of the questions that we've had. I feel like this was a great discussion, and it just has made new questions surface. And now we know that we can reach out to you to get answers to those. So thank you so much for being here and providing all this information. And I put your contact information just now in the chat, and along with the link to the feedback survey for this workshop. So if everyone could please complete that, that would be great. And I thank you and have a great afternoon.
Thank you.
Thank you.
Thanks.